the lump sum purchase of the assets. So what do we mean by lump sum purchase or basket purchase of the asset, right? For example, you paid a price for a land and building together. We call this lump sum or basket purchase. So several assets purchased in a group at one price. So total cost is allocated based on their market value. And this technique that we're gonna segregate it, how much is the cost of land, how much is the cost of building. We use the method RSV method, which is relative sales value method. So we have an illustration here. I just want you to pause the video and read the example or illustration here. Then we're gonna solve it in our next slide. So the crux of this illustration is that you bought land and building in a combined basket purchase with 2.8 million, right? So when you revalue or appraisal, the value, you found out that the market value of the land is 300,000 and the building is 2.7 million. So total this is 3 million, right? And you bought it for 2.8 million. So how are we going to record it? Well, what is the cost of land and what is the cost of building? If you record like this, then you actually paid 2.8 million. So entry would not be complete, right? So let's do this to learn. Let's learn the RSV method, which is relative sales method. How are we going to do that? Here we go. So we find out the pro rata basis or percentage value of the market value. So the market value is 3 million, and on this 3 million, how much is the portion of land and building? So you divided each by the total market value. You find out that 10% belong to land, 90% belong to the building. So 2.8 million multiplied by 10%, that belongs to, which is 280,000, belongs to land, and 2.8 million multiplied by 90% belongs to 252,123,4, right? That belongs to building. When you add it, this answer is 2.8 million, right? It's just a pro rata basis. So what is the entry when you purchase? Answer is building, land to cash. What is the value? Value through, we find out through our RSV relative sale value method. Okay, now just stop for a while and try to solve this example here that I pasted here. So you have to find out the cost of each asset. So you have a bucket purchase or lump sum purchase where you bought a land, building, and equipment. So just try to solve by yourself and match the answer accordingly. Here we go, right? Okay, so just pause the video over there and match the answer. Okay, now our learning objective 2, which is distinguish a capital expenditure from immediate expense. So let's talk about that. Basically, we are talking about capital expense versus the immediate expense or just expense, right? So what is the difference between capital expense and immediate expense or expense? Normally, in some books, there is a definition of expenditure and expense. So expenditure mean they assume that if we are talking about expenditure, it means capital expenditure, right? So no matter how much, whether you name it expense or expenditure, you should know the logic. Okay, let's talk. So capital expenditure is, or capital expense is that expense which actually increase the asset capacity or its useful life. So which means you incur an expense and the usage of that expense is for more than 1 year. Either it enhances the asset capacity and asset going to run for multiple years, or either you extend its life, which is also for more than 1 year. So that's why we call this capital, right? So capitalized means the cost is added to the asset account, which means you add this cost to the cost of the asset. Rather, you send this cost to the income statement, right? So here we go. Record an asset as a capital expenditure, number 1, which is major engine overhaul, right? Major engine overhaul. It's not routine, tuning or something else. Modification of body for new use of truck, addition to storage capacity of the truck, right? So did you notice something here, that is the usage is for more than 1 year, right? So that's why we added word capital or capitalized, right? And what we call the expense, which will go to income statement, repair for like transportation, transmission, or or other mechanism, oil change, lubrication, so on, replacement of tire, windshield, or paint jobs, right? These are, and their usage is for less than for 1 year, or they're going to be expire less in within 1 year of time span, right? Then we call this ordinary expense, and that will go to income income statement. Okay, let's talk about measure and record depreciation on plant assets. So now let's talk about depreciation, and depreciation that allocates plant's costs to expense over its life. For example, you purchase a plant for $1 million for 10 years. Since you incurred it and it's gonna increase your sales, it can increase your business operations, increase your sales, increase your profit, but this cost is huge, right? And you cannot, and the use of assets is also for more than 1 year, right? So what you're gonna do, there are different methods. We talk about that, how we calculate the depreciation, but the simplest method is that, for example, you divide it with 10, answer is 100,000. So every year you expense it with income statement, right? And every year, for example, year 1, its value was 1 million, year 2 its value was 900,000, because you less depreciation of 100,000, and again it's like then 800,000 year 3. So at the end of 10 years its value would be 0, right? And then allocates cost, again the revenue assets help to earn each period, right? So this asset going to be used in generating the revenue as well, right? Even the chairs, computers, they also increase your productivity, like order processing and order getting, right? This kind of stuff. So this basically, every asset that you purchase in a company, it would help to increase the efficiency or productivity of the business, ultimately increase the sales and increase the profit as well. So the depreciation expense, which is different from accumulated depreciation. Accumulated depreciation is contra account of the assets, right? So all the depreciation we talk about in our earlier lecture, what is accumulated depreciation, and we talk about there as well that the accumulated depreciation is basically the contra account of the assets, in which we less the amount of the assets, and basically this is the addition of all previous year depreciation. So depreciation expense, it is represented on income statement, while accumulated depreciation is represented in balance sheet. So land is not depreciated, right? Because every year land value increases. Even if there is a credit crunch and the value of the land decreases, we don't call this depreciation, we call this impairments. We will talk about later, or I think that would be discussed in advanced financial accounting. So what do we mean by depreciation? The myth regarding the depreciation is that it is valuation process. No way. Depreciation is not a valuation process. Neither it means that you are taking money out of the profit and you are making a reserve account, and after that, for example, if after 10 years you need to replace that asset, so you have some kind of cushion. No, that is also a myth, right? Remember this, it's not a valuation process, plus it does not mean that setting aside cash to replace assets as they wear out. So there is an exhibit 7.3 in your book, you can just refer to this and to further clarification. Okay, so how to measure depreciation? First of all, you need to know the cost, and cost include all those costs, right? Remember that we just learned about in our cost of building machine equipments, right? Installation cost, freight charges that buyer pay, any commission, installation, right? And also all those that you increase its life or its capacity, that is also included in the cost. And how we calculate the estimated life, which is length of service expected from the using the assets, and it can be expressed as in terms of years time, in terms of output, that this plant is going to produce 2 million units or 3 million units, right? Also in miles, for example, trucks or some other measure, you can use that. The third one is estimated residual value. What does it mean by residual value? Like after 10 years of the use of this truck, what is the worth of that truck when we sell it? We call this scrap value or salvage value. Some books will use scrap value, some which books will use residual value, some book will use salvage value. So it is also not depreciation, okay? So what is the depreciation? What is depreciable cost? Because this card at the end we're gonna recover, right? When we sell the asset, we're gonna recover this card. And there are some methods or there are market surveys to find out that after 5 years, what would be the value of our plant, because in our books we depreciate it to zero. So depreciable amount is equal to asset cost minus its scrap value or its salvage value or residual value. Okay,